In the weeks that have followed the implosion of the FTX cryptocurrency exchange, we have seen that billions of dollars worth of customer funds weren't the only casualty of this disaster. Everywhere we look, the market is flashing big red warning signs that people's trust in cryptocurrency related institutions has been absolutely decimated. People are pulling their cryptocurrency off exchanges en masse, and both Wrapped Bitcoin and Grayscale's Bitcoin Trust are trading at a discount to the underlying real Bitcoin. We're talking all about it and what it means in today's video. Hey everyone, and welcome back. This is the Part-Time Economist, and in today's video, we are talking about the massive loss of trust in cryptocurrency-related institutions and investment products that has followed the collapse of the FTX exchange. Now, for those of you who may have missed it, this is probably the biggest news in cryptocurrency of the last several years, I would say, but the FTX cryptocurrency exchange was a cryptocurrency exchange that collapsed, and you're probably thinking, so what? This is crypto. That happens all the time. The difference is that FTX wasn't some fly-by-night cryptocurrency operation. It was widely regarded to be highly trusted. It was one of the most reputable cryptocurrency exchanges, and many people legitimately saw it as a safe place to put their crypto. It was one of the good guys, so to speak. So the collapse of this exchange wasn't just massive in terms of the dollar value of funds lost, but also because people thought this was supposed to be the trusted, the chosen one, right? And if it could go under, what's stopping any other cryptocurrency exchange from going under as well? So we saw billions of dollars worth of crypto lost, but as we're talking about in today's video, we also saw the lack of trust rippling throughout the cryptocurrency ecosystem. So before I start with that, I do want to give my standard disclaimers. This is not financial advice. These opinions are simply my own. They don't reflect anyone else's opinions or viewpoints. So with that being said, let's look at a couple graphs here that really illustrate what's going on. We can see this article from CoinSlate essentially shows us that over time there has been a slow increase in the amount of Bitcoin that has been in an illiquid state. What's an illiquid state? It's Bitcoin that's not on exchanges. You're keeping it in a cold wallet, offline, a paper wallet, something like that. It's not on an exchange. And we saw that there was a generally upward sloping trajectory for people keeping more Bitcoin off exchanges. However, take a look at that last little portion of the graph. You can see that it's gradually trending upward, and then boom, it shoots up like a rocket ship. That is the FTX effect, I'm going to call it, because again, I want to really reiterate, this wasn't just another cryptocurrency exchange that no one's ever heard of. This was supposed to be the golden standard of what a trustworthy, altruistic cryptocurrency exchange is supposed to look like. And people said, hey, this was not only one of the most trustworthy exchanges, but one of the biggest. If they're going under, if they're going bankrupt, what's to say that Coinbase or Binance or Kraken can't do the same, right? And I want to be clear, I'm not saying that Coinbase or Binance or Kraken is the same, that they're doing the same shady practices. I do not intend to imply that by any stretch. But people are thinking these things, right? They're saying, hey, I can't trust the good guys. I don't know who I can trust. It's just too risky. Give me my funds. I will keep them myself. And kind of related to that, we see the price of Grayscale's Bitcoin Trust trading at a 45% discount to the value of the underlying coins. Now, this requires a little bit of understanding of how the trust is set up to really fully grasp the implications of this. Grayscale's Bitcoin Trust is an investment vehicle. It's not exactly a mutual fund. It's not an ETF, but you can kind of think of that just for the general purposes. What this fund does is it invests in Bitcoin, and it holds those Bitcoin, and it has a certain amount of Bitcoin. The actual number doesn't really matter for our purposes. you don't invest in Bitcoin. You invest in shares of the fund, and then kind of by extension, you have kind of a claim on a certain amount of those Bitcoins. So the cool thing about this is that it allows people to get exposure to the underlying Bitcoin asset, but in the form of a traditional security, right? So this is something you could trade through your brokerage. It's something that you don't have to worry about crypto taxes or things like that, because you are investing in crypto, but it's through the form of a traditional security. So you might even be able to put it in your IRA, things like that that you can't do with traditional cryptocurrency. So it is attractive from that perspective. However, we see that it is now trading at a 45% discount to the coins that it owns. Now, what does that mean and why is it important? Funds generally have something known as their net asset value. That is, let's suppose I have 1,000 shares of this fund. I own $10,000. Well, each share is going to be worth $10, right? It's all the assets I own divided by the shares. And with traditional mutual funds, you can redeem those shares. So at the end of the trading day, generally 4 o'clock Eastern time, I can say, hey, I want out of this fund. Give me the net asset value proportional to what shares that I actually own. And so you can get your claim, your value. Grayscale's Bitcoin Trust, however, is not redeemable. This means that no matter how high or low the price of the shares actually go, you can't just say, hey, give me the value of the underlying coins that my shares represent. You have to trade your shares to someone else. So essentially, a way to look at this is to say, okay, Grayscale is holding these Bitcoin, but I can't redeem them, right? So I want physical Bitcoin. I can't get it. So what the market is telling us here is that the difference between having a claim on Bitcoin and actually owning the Bitcoin, one way of interpreting that would be to say that people are paying a 45% premium to hold that physical Bitcoin, right? Because again, the idea here is, how do I know I can trust you? I just want my Bitcoin. Since I can't actually get my Bitcoin, I'm going to sell my shares and maybe I'll go buy real Bitcoin or something like that. So very interesting there. And then kind of related to that as well, we see that wrapped Bitcoin loses its peg against real Bitcoin. Now, again, this requires a little bit of knowledge of what's going on behind the scenes. We have Bitcoin. Bitcoin is one Bitcoin, right? It's the original cryptocurrency. It's just there. Now, in order to use Bitcoin on other blockchains, such as the Ethereum blockchain, to lend Bitcoin out through decentralized finance, it needs to be put inside a wrapper. So essentially, the simplified process of this, we have a Bitcoin, we essentially lock it up, and once that Bitcoin is locked up, we mint on a different blockchain a claim. We say, hey, this is worth 1 Bitcoin, because you can see here we've locked up 1 real Bitcoin. So when you redeem this wrapped version with us, we're going to unlock the real version. So there's supposed to be one in the same, just with some added functionality of using Bitcoin on another blockchain. However, we see that, again, people are saying, I don't want a claim on an asset, right? I don't want this, well, we maybe have a Bitcoin that's in a smart contract somewhere, and yeah, we'll probably give it back to you when you want it. People are saying, no, we want the real thing. We want the real Bitcoin. So again, that wrapped Bitcoin trading at a discount, right? So a discount means it's not at as a high of a price. If Bitcoin's, I'm making up numbers here, Bitcoin's 20,000, wrapped Bitcoin's only 19,000. That's saying, hey, there's $1,000 difference between owning a wrapped version and the real version. One last thing I do want to briefly talk about here is Binance allocating another $1 billion for its crypto recovery fund. Again, this speaks to the massive loss of trust within the cryptocurrency ecosystem. I think we're starting to see that the institutions themselves are realizing, hey, this bank run, this loss of trust, if one part of the cryptocurrency one part of the cryptocurrency ecosystem goes down, it affects us all. So we need to have some kind of insurance, some kind of recovery fund, because remember, within crypto, there is no FDIC, there is no SIPC coverage. There's very little protection, and these cryptocurrency big players are realizing, hey, if some exchange, right, if Luna goes down, if FTX goes down, right, that is going to hurt all of us. So they're kind of getting together and creating their own bailout fund, essentially, which I find very interesting. It kind of takes us back to the Panic of 1907, which, as many people know, is before the creation of the Federal Reserve. The U.S. financial market wasn't as well regulated. We didn't have as many safeguards, and exactly like we see in cryptocurrency, when there was a failure of one institution, it starts dragging everyone down. So back in 1907, even JP Morgan and some of his banker colleagues essentially used their own private money as a bailout for the entire American economy. The thinking was, hey, if we don't do this, it's going to get worse. It's going to hurt us as well. So I find it very interesting that whether it's 1907 or 2022, people are always going to try and come up with ways of mitigating risk, right? We didn't have FDIC and SIPC in 1907. Crypto doesn't have FDIC and SIPC now. So in both cases, individuals were trying to come up with ways of insuring themselves and kind of not just protecting the ecosystem, but protecting their own interests as well. But with that being said, I really hope you got something out of the video. I appreciate you watching, and I'll see you next time.